Let's now talk about trade execution. So I've already mentioned the distinction between bid price and ask price. So again, this is from the context of a dealer. So bid is how much he will buy for and ask is how much he will sell for. Bid is always going to be lower than ask. The difference between the two, bid minus ask spread, is essentially bid price minus the ask price. The liquidity of a given stock determines generally the bid-ask spread. So if a stock is very liquid, that means that the liquidity is very high, so that's a good thing. Then the bid-ask spread is going to be very low. So this is easy to relate to in the Pakistan context with currency. So the most liquid currency here is the US dollar. So if you notice, the bid-ask spread for the US dollar will be very low. On the other hand, if you take another currency such as the Australian dollar, you can buy and sell Australian dollars, but since the liquidity of the Australian dollar in our market is not as much, the bid-ask spread will be slightly higher. The same goes for stocks. So stocks that are very liquid will have a low bid-ask spread. Stocks that are not so liquid will have a high bid-ask spread. You need to understand that there are some traders who make the market. So if for a given stock you have a trader who does a lot of buying and selling in that stock and maybe also has an inventory in that stock, we say that that trader makes the market. And then other traders who simply buy and sell from the trader who makes the market, those other traders are called traders who simply take the market, or essentially they take what the market has to offer. Now let's talk about the execution of order instructions. And execution simply means when you tell your broker or your dealer how to trade. So the most simple kind of execution instruction you can give is a market order, where let's say you own shares of General Electric and you tell your broker that just sell 100 shares of General Electric at market price. So essentially that is called a market order. A limit order is where you not only do you say that you want to buy or sell, but you also specify a price. So let's say that a given share X is trading for $50. A limit buy is where you tell your broker that you want to buy this share, but you feel 50 is slightly high, you would buy this share for 49. So you might put a limit buy where you say that you will buy 100 shares for 49. So this is called a limit buy order, where you are saying that if the price comes down from 50 to 49, only then should the broker buy for you. A limit sell is somewhat similar, except now you are saying that you want to sell if the share price is at 52. So a limit sell at 52 means you are telling your broker that if the price goes up to 52, then sell, otherwise hold on to the share. Let us look at the limit order book for a given stock, such as say FFC. What we see here are order prices shown in the limit order book. On the left we have the bid prices. So bid prices represent the prices at which traders are willing to buy FFC shares. So let's say that there is a bid at 88, then 87, 86. So what this means is that there is a trader who is willing to buy FFC shares for 88, and then there is another trader who's willing to buy FFC shares for 87, and so on. On the right we see the ask. So ask is how much the traders are asking for, or in other words, how much will they sell FFC shares for. So one trader is willing to sell FFC shares for 90, another will sell for 91, and so on. Now, a limit order book will also specify the amounts, or could specify the amounts, but I have not, for simplicity, I'm not showing that information here. So, in terms of terminology now, the 90 and the 88, these are orders that are at the market, because, so if you notice, the highest bid price and the lowest ask price are the prices that are at the market. So ask orders, or ask orders that are close to 90 are called aggressively priced, and these prices that are far away from 90 are less aggressively priced. Bids, the bid at 88 is at the market. The bids that are close to 88 are aggressively priced, and these are far from the market, or they are not aggressively priced. So that's what we mean by aggressively priced. Marketable, as I mentioned earlier, the 88 and the 90 refer to the marketable orders. All these orders in general, all these bids and these asks are referred to as standing limit orders. A little more terminology, as I've sort of already mentioned, the difference between 88 and 90 in this case is called the bid-ask spread. So the bid-ask spread is 90 minus 88, which is 2. And if a new ask comes in at, say, 89, then that is called making a new market. So essentially, when an ask comes in that is inside the market, so inside the market means a new order comes in that's between 88 and 90, we say that's inside the market, and that then essentially creates a new market. But as things stand right now, the market is at 88-90, which means bid price 88, ask price 90. So that explains all these terms over here. An all or nothing order means if somebody has put in, so if a trader is asking for 91 and he is selling 1,000 shares, so an all or nothing order means that he will only sell all 1,000 shares if he gets 91. He is not going to break this into smaller orders and sell at different prices. So that's all or nothing order. Hidden orders are orders that are hidden from the investing public. So hidden orders are only visible to the exchange and the broker who is putting forward the hidden order. Iceberg orders are orders that are mostly hidden. So for example, if Goldman Sachs wants to sell 1 million shares of XYZ company, but it only shows order of 1,000 shares, and when this executes, then it will bring up the rest. So this is called an iceberg order because only a small percentage of the order is displayed, the rest of the order is hidden. Validity instructions refers to instructions about when to trade. So these are all examples of validity instructions. So a day order is an order that can be executed throughout the day. So a day order is an order that is good for the day. So if you place an order on, say, 3 October, then that means that as long as the order fills or is executed on 3 October, well and good. Otherwise, the order doesn't carry over to the next day. And this is one of the most common types of orders. An immediate or cancel order, also called a fill or kill order, means that the order should either be filled immediately. If not, then the order is cancelled. A good on close order means that the order should only be filled at the close of trading. Market on close means that if the order is a market order, from the last slide, remember, a market order is one that can execute at market price. So if a good on close order is also a market order, then it is called a market on close. We can also have stop orders, and the purpose of stop orders is to sort of limit losses. We have two kinds of stop orders, a stop sell and a stop buy. Idea being that let's say you own shares that are currently at $50, and let's say that with this share price, the most that you can lose, or the most that you want to lose, is 10%. So you are hoping that the stock price goes up, but let's say you are worried about the potential of stock prices going down and you losing money. So you can put a stop sell at $45. This means that if the stock price starts going down and it hits 45, then you are essentially telling your broker to sell and just limit your loss at 10%. Obviously, what you are hoping for is that the stock price goes up and you never really have to sell at 45. A stop buy is useful when you have engaged in a short selling transaction that I spoke about briefly earlier. So what happens in a short sale? In a short sale, let's say that you have borrowed shares and sold them for, let's say again, $50, and what you are hoping for is that the stock prices go down. So let's say when the stock price goes down to 40, as described in my earlier example, then you would buy the shares and give the shares back to the broker and pocket the difference between 50 and 40. But if your view turns out to be incorrect and the price of the share starts going up, to limit your risk, what you might say is you might give an instruction to do a stop buy at 55. So what that means is if the market starts going up, you simply then buy the stock for 55 and essentially lock in or limit your losses. So on a per share basis, then simplistically put, your loss will only be 55. If you don't do this and the stock price keeps going up, then your loss can be unlimited. Clearing instructions refer to how the trade should be settled. So this is from the curriculum, that an important clearing instruction that must appear on the security sale is an indication of whether the sale is a long or a short. In either case, the broker representing the sell order must ensure that the trader can deliver securities for settlement. For a long sale, the broker must confirm that the securities held are available for delivery. For a short sale, the broker must either borrow the security on behalf of the client or confirm that the client can borrow the security. Now let's talk about primary and secondary markets. I have referred to these briefly earlier. Here we'll talk about it in a little more detail. So primary capital market, so remember the core point with the primary capital market is this is where the issuer of shares or issuer of bonds gets money. Okay, we can have two kinds of primary capital markets. So two kinds of transactions. One is called a seasoned offering or a secondary issues, and the other is a initial public offering or IPO. In an IPO, a company issues shares for the first time. So approximately a year ago, a company in Pakistan called Fatima Fertilizer had a IPO. So this means that it issued its shares for the very first time and then went public. Now if Fatima Fertilizer issues shares again, then that would be called a seasoned offering or a secondary offering. Typically these primary, so in a primary market, typically you have the issuer involved and an investment banker that is involved. So typically what an investment banker tries to do is find entities that are willing to subscribe to the IPO or the secondary offering, and as the investment banker identifies potential investors, so each investor's interest is called an indication of interest. So an indication of interest is not a commitment, but it gives a sense for how much investors are willing to pay for the shares. So if investors are not willing to pay too much for the shares, then the share prices come down. If investors are willing to pay more, then share prices can go up. The process of collecting all these indications of interest is called book building, and the investment bank that is building this book is essentially called the book runner. Now, an investment bank can either officially do the underwriting, so this is called an underwritten offering, or can operate based on a best effort basis. In an underwritten offering, the investment banker is taking the risk, where he is essentially saying that he will buy, say, a million shares at a given price, and then the investment banker is basically has to make sure that the price that he has committed will be met, even if it is from his own pocket. A best effort basis means that the investment banker is going to do his best to get the highest possible price per share for his client, but does not make any commitments. So you need to be aware that in this whole underwriting process, there is a conflict of interest between the investment banker and so there is a conflict of interest. There is a conflict of interest from the perspective of the investment bank, because the investment bank would like to buy shares from the issuer at a relatively low price, and then if the shares are bought at a low price, they can be offered to the best clients of the investment banker, and then if the initial issue was at a low price, the price of the offering will go up in the future, which will make the clients of the investment banker happy, and it will also make the investment banker happy. For this reason, most IPOs are underpriced. However, if we have a situation where there is tremendous interest in a IPO, where let's say 1 million shares are being issued initially, but there is a demand for more than 1 million shares, this is called a hot issue, and a hot issue is an indicator that once this goes public, then the price is going to go up if the demand for the issue is more than the supply. Private placement is where shares are not offered to the public, but shares of a company are offered to a private entity. DRIP refers to a dividend reinvestment plan. So what happens here is the dividends paid by a company are used to buy back shares of the company, usually at a bit of a discount. And rights offering refers to a situation where existing shareholders are given the right to buy new shares at a discount to the current market price. So just some basic terms that you need to understand. Secondary financial markets are basically markets like the Karachi Stock Exchange, the New York Stock Exchange. So these are where shares trade. Now, when shares trade, say FFC shares trade on the Karachi Stock Exchange, this buying and selling, the money does not go to the issuer, which is FFC, but these secondary markets are extremely important in terms of how they support the primary market. If a given share is very liquid, so easily bought and sold in the secondary market, then it is easy to raise money in the primary markets. On the other hand, if a given share is not very liquid, then that makes it difficult to raise money in the primary market. The other important point is that secondary financial markets clearly help establish a price for the share, and then that also makes it easier to figure out what price must the shares be offered for in the primary market. So if the share price is doing very well, then FFC can raise more money in the primary market. If share prices are down, then that means that cost of equity is high, because FFC would raise money at a relatively low share price. Market structures. So some more definitions to learn. You need to understand the distinction between call markets and continuous markets. In a call market, securities are traded at a specific place and a specific time. So for example, this might happen when the regular market closes. So during the call market, there will be a specific time from say 5 to 6. So at a specific place and a specific time, the securities are traded. So during this time, the call markets are very liquid, and then outside this time, the call market is not operating. In a continuous market, we have basically trading that can take place throughout the trading day. So from say 9 a.m. to 4 p.m., if that's our regular market time, then say, let's take the example of the Karachi Stock Exchange, that would be a continuous market where trading can happen anytime during these trading hours. So that is called a continuous market. Quote-driven markets, these are markets where traders transact with dealers who are called market makers, who post bid and ask prices. The dealers maintain inventory of securities. These markets are also called dealer markets or price-driven markets or over-the-counter markets. So very roughly speaking, NASDAQ is an example of over-the-counter market. Essentially, for any given stock, there will be dealers who give their quotes on how much they are willing to buy and sell stocks for, and hence this is called a quote-driven market. In a order-driven market, orders are executed using trading rules. So here we don't have dealers. We essentially have brokers, either who are in-person brokers, or you can have electronic crossing networks that act like virtual brokers. And here, based on certain rules, buy orders are being matched with sell orders. So a very simplistic rule might be that a person who's willing to buy at the highest price and the person who is willing to sell at the lowest price, their orders will be matched. So that's an example of a simple matching rule. Similarly, there will be trade price rules, and this term electronic crossing network or ECN refers to a situation where the buying and selling is happening electronically based on predefined rules. A quick elaboration on the trading price rule. So this simply refers to rules which are used to determine the exact trade price. So for example, if somebody is willing to buy for 29 and somebody is willing to sell for 29.50, then there might be a trading rule that the price is determined in between, and there can be different trading rules, but that's just one simple example. Brokered markets are markets which are somewhat illiquid and where a broker needs to find a buyer and seller. So a classic example is the real estate market, where if you want to buy some land, you basically have to go through your broker, who finds the broker of a seller, and the brokers interact, and finally the transaction is made. So in Pakistan, these people are referred to as real estate brokers. In the US, they are referred to as realtors. So markets can be either pre-trade transparent or post-trade transparent. A market is pre-trade transparent if investors can obtain pre-trade information regarding quotes and orders. So that is a good thing. As investors, we would want markets to be pre-trade transparent so we can see exactly what's going on. So that would be informationally efficient. A market is post-trade transparent if investors can obtain post-trade information regarding completed trades and prices. So obviously, being pre-trade transparent is better from a investor perspective. In general, buy-side traders, so those who are buying stocks, will value transparency because it allows them to understand security values as well as trading costs, so they can then figure out what is the bid-ask spread and so on. Dealers, however, generally prefer opaque markets or markets where pricing is not very clear, because this provides them with informational advantage over traders who do not trade as frequently. And in such opaque markets, generally the transaction costs and bid-ask spreads are relatively high. So what are the characteristics of a well-functioning financial system? There are a few basic points. One is that we have complete markets. So in a complete market, investors can save for the future at fair and reasonable rates of return. We have credit-worthy borrowers who can receive money relatively easily. Hedgers can use various forms of derivatives to hedge their risk. So Pakistan, for example, Pakistani financial markets would not be considered complete because we do not have sufficient access to derivative securities that would allow entities to fully hedge their risk. And in a complete market, traders can obtain currencies, commodities and other assets as they please, as long as they are willing to pay market prices. A market is said to be operationally efficient if all the transactions that the market wants to perform can be done at relatively low cost. So essentially, operational efficiency of a market means that transaction costs are low. If transaction costs are low, then anytime there is mispricing, it will be relatively easy for traders or investors to buy or sell. When transaction costs are high, then mispricings in the market will persist, because even though you might spot a mispricing, but if the transaction cost is too high, you might not be able to take advantage of the mispricing. An informationally efficient market is market where all necessary information, all material information is easily accessible to all traders and investors. So an allocationally efficient market is a market where capital is allocated for its most efficient use. So whoever benefits most for the capital is willing to pay the most for it and is able to get that capital. Markets where there might be high subsidies and so on would obviously not be allocationally efficient. Finally, a few points related to the objectives of market regulation. So there are some obvious points, and as long as you know the points on the slide, I think you'll be in good shape. So clearly, good market regulation is such that would prevent any fraud, any theft. We want to prevent insider trading. Whenever there is insider trading, the market loses credibility. You will not want to buy or sell shares if you believe that the person that you are dealing with has more information than you have. So market regulation tries to prevent insider trading. Establish minimum standards. So there are minimum standards that must be upheld. So a classic example would be that there would be standards set for say initial margin, maintenance margin. So this helps ensure that there is no defaults. You want to make information as easily available as possible. This would help investors evaluate performance. So a key point here, just to explain this to an example, is for a share to be publicly traded, there is a tremendous amount of information that must be disclosed before shares can be traded. So with that information disclosed, that allows investors to evaluate performance. That allows investors to evaluate performance more effectively. And finally, we want regulation that helps minimizing defaults by requiring minimum amounts of capital. So this also relates to the example I gave earlier. In the context of banking, there are minimum capital requirements that banks must keep in order to ensure that when depositors come for their money, the banks have it. when brokers do margin lending, they ensure that that investors have a certain amount of money as collateral in their accounts. When futures transactions take place, there again brokers require that there is a certain amount of minimum capital that is in the accounts of the traders, and so on. So from an exam perspective, I don't think this is hugely important, but still you should know all the core points mentioned over here. And that brings us to the end of this long reading. As always, practice. If you have comments, suggestions, please post them on YouTube. And if you like this video, please click on the like button. That is it for now. Thank you and bye-bye.